Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. We want to thank all of our viewers and listeners for tuning in again to another episode of the weekly update. Now, before we begin, you'll notice I'm in a suit and tie, and part of that reason is that as things get back to normal, as the economy is reopening, we wanted to build on that theme of not just America getting back to normal, but the everyday workplace getting back to normal. And certainly this was part of our routine before COVID hit, and we want to get back to that. And so that largely plays into the theme of our portfolio and some of the big shifts that we've been making over the last 2 weeks. And so the theme of this week's update is really about how we're trying to avoid the eye of the technology storm, and then two, the big shift that we've made into energy, industrials, financials, really over the last 2 weeks. And the theme is rebuilding the West, right? And this is a theme that's going to play out not just over the next 3 months, 6 months, but over the next 12 months. And when we think of one of the big impacts it's going to have on the portfolio is correlation to the S&P 500 is going to dramatically drop. And so what does that mean? So on days when the S&P 500 is up, you may very well experience days that are down in your portfolio, or there may be days when the S&P 500 is flat and down and it's up, or it could be up and up. And the reason for that is our large overweight in energy. Right now, energy is around 4.5% weight in the actually around 3.5% weight in the S&P 500. We're around a 34% weight. So as energy fluctuates, the portfolio will fluctuate much differently than the overall index. So if you ever see days where you're up and the market's down or vice versa, that's probably the prime culprit. Look to oil prices, look to the action in the energy patch, and that's probably what is taking place in your portfolio. But the bottom line here is our base case scenario is that we are very bullish on stocks here, not just over the next couple of months, but really over the next few years. And that is because we believe, based on our research, that we are in the middle of a 20-year secular bull market. What are the reasons for being positive on stocks, ladies and gentlemen? Money remains cheap. Whether we're talking low interest rates, we're talking money printing, these are the types of things that while we may not agree, we may disagree with it, it doesn't matter. We want to understand the impact on asset prices. Second, year two of a recovery is where we see corporate earnings play out in real time. We're seeing a very strong recovery in corporate earnings. We're going to look at the charts to see how that's playing out, both not just in expectations, but in actual earnings. Credit markets are rock solid. At the end of the day, if credit markets were deteriorating, that would give us serious pause, not just about how to allocate the portfolios, but the longer term health of the secular bull market. Relative valuations remain attractive. Stocks are more attractively priced than all other liquid asset classes out there. Very important point. It's not an absolute game, it's a relative game. And then lastly, but certainly not least, too many people own bonds. Right? If we look at obviously the baby boomers going through retirement right now, they're flush with bonds at record low interest rates. As those bonds come due, as people rotate out of bonds, it's going to be a tailwind in a generational basis for equities, especially as those generations gift and pass along those assets to millennials who are in their prime earning years and tend to own stocks at a higher rate versus bonds. Now here in the very short term, when we look at trading conditions, the last week has been pretty scary. The market's come down about 4 or 5%, but I will say we've actually picked up a couple of points in terms of relative performance versus the market, thanks to our overweight position in energy. I think we're underperforming a little bit today, just because energy is down. But overall, we started to close that relative performance gap. And then what are some of the sort of the trading conditions here over the last few days? First of all, we've largely completed the portfolio shift. So I want to announce that. We made the last sort of wave of trades went through yesterday. So we're largely finished. You'll likely see a couple, trades around the edges here over the next week or so, but the vast majority of that shift has been completed. Also, let's ignore the noise of the past 3 days, ladies and gentlemen. Guess what happens on Monday? Taxes. And we've all probably, to some degree, been selling stocks to pay the tax man, unfortunately. And that's been happening countrywide. And so you're seeing a lot of selling as it relates to that tax deadline come around on Monday. So any market noise you've seen here over the last 3 days, ignore it. VIX has jumped 80%. When the VIX jumps 80% over a 3-day period, historically, that's a capitulation period. We want to buy into that capitulation, not sell into that fear. And we see that with the put-call ratio, where the put-call ratio for equities hit 0.63. In other words, massive protection seeking, which is a counter trend buy signal. Very, very important. The other thing I will say is tech stocks continue to be a source of funds. When we look at those 10-year charts, it is a generational top that appears to be taking place. If we look at many of the stocks that we even previously owned, 3-4 weeks ago, they're still, a year over year basis up 40, 50, 60, 70% in some cases. So we think that those are going to continue to be a source of funds to fund energy positions, industrial positions, financial positions, as the economy retools, reshifts its focus to rebuilding its infrastructure and to compete with major powers like China and Russia in the 21st century. So all of these are sort of the short-term trading conditions. They point to a capitulatory environment where we should be set up for a good move here in stocks upward over the next couple of weeks. Obviously can't guarantee that, just looking at what those trading indicators are looking at. And then it is interesting to note that credit markets haven't flinched and crypto assets are looking a little shaky. Real quick, valuation wise, this is where the S&P 500 is, well, 22.7 times earnings, not cheap on an absolute basis historically, but I would note, guess what? Everything else is more expensive. The only thing that's cheaper are some of the individual sectors, such as utilities or US healthcare. Emerging markets also look very cheap. Interesting, because they are commodity driven. What are we overweight right now? Commodities. So again, yes, when you read that PEs are high on an absolute basis, they are from a historical standpoint. But guess what? They're also the cheapest they've been relative to history. They're very, very cheap relative to all other asset classes, because all other asset classes are trading at a massively high PE. Money has to go somewhere. We need to seek it. We need to skate to where the puck is going, not chase it around the rink. Now, earnings revisions. Now, for people who have worked on Wall Street, will know that earnings estimates tend to start really high and throughout the year tend to be adjusted lower as that positive sentiment sort of hits reality a little bit. That doesn't mean it's bad for stocks. Analysts just tend to be a little bit too bullish. What's interesting is that estimates are actually going up as we go throughout the year. And what is that telling us? That is telling us, and we can see that line here of the estimates and the individual estimates over here. What that is telling us, quite simply, is that people, that analysts, strategists, they are all underestimating how durable and long-lasting this V-shaped recovery is going to last. And so very important point here that earnings revisions are moving higher. It's not really a symptom of a bear market. Now, in the short term, we have seen a massive vol spike. So quite simply, when volatility spikes 80% over a 3-day period, that tends to be very capitulatory in nature. We do not want to sell into these events. We can see here in this chart, with the exception of that COVID spike, obviously, you get these spikes and then the market tends to resume higher after you flush out some of that speculative money that might be in the market over the very short term. This is healthy, keeps us all honest as investors, keeps reminding us that markets can go down, they don't just go up. But again, within a bull market, this is tends to be capitulatory in nature. And we can see that high put call ratio here, which again, emblematic of some panic selling here over the last couple of days. Now, why do we love energy so much? The energy industry has seen almost no investment over the last 4 to 5 years. And guess what? We're using more oil than ever now. we're surpassing 2019 levels, especially as we get into a V-shaped recovery. If we're going to rebuild the West, we're going to need copper, we're going to need iron ore, we're going to need oil and gas, we're going to need all this stuff. And we can see here, the overall investment is way below trend. And so there's a structural gap to keep production where it is. Who's going to benefit the most? We believe, based on our research, the oil service industry is well positioned. Take a look at this. This is the chart of the oil service ETF. It is around 80% off its 10-year highs. This is a sector that has been in a 10-year bear market. So we're not talking astronomical prices like we see over in technology. It is literally, if you bought into energy 10 years ago, you were down a lot. And so this is a sector that is starting to put in higher lows. It's got safe balance sheets now. They've largely de-risked and de-levered. And we're starting to see sustainable cash flows being generated in the sector. And of course, it's unloved and no one owns it. That is the recipe for a long-term bull market. So when you look at this chart and you ask us, where do we see the upside over the next 10 years? This is the upside, just getting back to where we were 5 or 7 years ago. And then again, we can see that here with the XLE, which is the EMP, the production company ETF within energy, again, emerging out of that 10-year bear market. Why do we want to be careful with technology right now? Again, this is the ARC ETF, very emblematic of the most risky areas within the pocket, with the most risky pockets within technology. This looks like a generational top. Again, we want to be very careful about these no sales, no earnings types of companies. It's just emblematic of a broader breakdown that we're seeing, and investors have to somehow fund those positions in energy, industrials, and financials. And we think that technology will continue to be that source of funds. And lastly, but certainly not least, credit markets do remain healthy. And we can see, again, they have not flinched at all. The foundation of the financial system remains strong. So overall, we continue to see that we're emerging from this big portfolio transition over the last 2 or 3 weeks. So there's been a lot of messiness over the last week. So give it some time, allow these stocks to settle into their new home. And we think that we are very, very well positioned here to generate alpha over the next, over the remainder of the year and beyond. Where are we going to generate outperformance? Energy, industrials, financials. Those are our key overweights against the market right now. So if we're right in those 3 sectors, we should be able to outperform. But if we're not, we'll underperform. And that's really sort of the key variable at play right now. So if anyone has any questions or concerns, please feel free to reach out to our offices, or please feel free to reach out to your advisor, first of all, and then reach out to our offices here at 888-543-3776. Thank you again for tuning in. We really appreciate all of your business and your patience through this transition period, and have a fantastic weekend.